Hello, everyone. My name is Prerna Divecha, and I'm the Senior Director within the Asia Pacific Credit Product Specialist Group at S&P Global Market Intelligence. Before I begin, please note that the activities of S&P Global Market Intelligence are independent and separate from S&P Global Ratings. S&P Global Ratings maintains the separation of analytical and commercial activities. Now let's get started. In the next 30 minutes, we're going to cover some key topics around automating credit risk workflows. We'll cover 5 key considerations for the credit risk workflow and the common challenges in automating the credit risk workflow, followed by recommendations. To begin our discussion, on the next slide, I'll start with the basic question that companies lending or extending credit need to answer and the desired outcome, namely whom to extend credit and how much credit to extend. Now, to answer those questions, you may need to take on board a plethora of information. Normally, at a minimum, they will need to access KYB information for the business they're considering, as well as data sets and around thermographics, which will normally help there. Understanding the ability of the company to repay their debt, ideally utilizing credit scores such as risk gauge from S&P Global, financial data, ratios, quantification of losses in the event of non-repayment, which a loss given default model can help with, such as loss stats. Assessing the intention of the customer to repay with trade payables or trade payment scores, such as pay sense, can be useful. And finally, what should be my maximum exposure or credit limit to this customer, which our own S&P framework, such as max limit, can help give initial indication for trade receivables. This information can then be fed into your credit rules and lead to a credit decision. Should I extend credit or not? And what should the limit rate and other terms be? Ideally, you want to automate this as much as possible. And if done successfully, will result in faster credit decisions for your customers and counterparties and reduce operational expense and provide a more accurate credit risk pricing for those customers. Defining your credit risk management workflow and identifying support data and tools can really help to facilitate automation of significant parts of that process. Automating key components of extending credit to reduce the number of errors enable further standardization of practices across the organization, while naturally improving the information workflow. Here, there are 5 key areas that we've identified for engagement with our clients across many different types of businesses, be it banks, non-financial corporates, or fintech companies. We've seen common trends and some common workflow arrangements across all of these institutions, and these seem to be an important part for the automation process. On the next slide, we will run through these key areas and run them through clockwise, starting from business origination as a way to frame the follow-up discussion. Herein you see in the first block, by business origination, we mean the start of the process. Within this stage, a company will screen potential customers or counterparties, sorting out those that do not meet certain criteria, creating new sales orders, assess credit or loan opportunities, and then undertake due diligence. If the company under consideration passes this step, and this step involves more in-depth credit analysis, then you will note that the detailed analysis is undertaken on the full company financial statements, the income statement, balance sheet, cash flows, and several ratios that are available, in addition to credit scores and payment trends. Credit limits are then calculated and the credit memos are produced for consideration of the business. If successful, it moves into the financing or underwriting phase. And with the credit decision, the final verdict is delivered to the customer. There will need to be internal approvals, account setup, and a lot of other operational aspects for the successful close of that loan opportunity. Then we move on to the credit risk monitoring or portfolio management, where we periodically look at the performance of the customer, updating support documents, identifying any early warning signals, and amongst other things, assessing concentration risk as well. The next phase which is also linked to risk monitoring concerns the credit covenants or collateral linked to your customers. Sometimes they will have explicit guarantees or additional support from a parent that should not only be factored rather into their credit risk pricing, but also checked for expiry. So now on the next slide and onwards, we'll go through each of these areas in more detail with the challenges and recommendations based on many credit risk workflow solutions that we've helped our customers influence. I want to take a pause and mention that in our survey of clients, we noted that screening and assessing company financials and payment information for use with backup data, validation data, or inputs can be difficult to gather. And this has been something that they've voiced repeatedly. This impacts the automation process, especially when analyzing small and medium enterprises. The ownership structure of companies is another one, and whether they have parents or subsidiaries is another element that needs to be understood. These two can have an impact on the strength of the focus of the company, but it can also be difficult to assess of all the linkages that may be available in that company. And when you have an entity that you want to enrich with other data sets, it's also essential to map these companies to those data sets. But if you want to avoid massive manual data mapping, which can be part of this whole exercise, that can be possible as well. In terms of recommendation, the first recommendation would involve having an automated tool to extract company financials from documents and mapping that to a standard chart of accounts and financial line items to avoid time-consuming and sometimes error-ridden exercises of manual data mapping. Regenerating credit scores can be the quickest way to screen companies of interest here. If coverage already exists for the company in question, otherwise utilizing a third-party credit model in conjunction with company financials can also save model development or act as a second source of validation. Finally, credit risk benchmarks can immediately give a relative view of country and industry risk, better informing your decisions and better informing your overall view of that company. Integrating customer ownership and hierarchy data feeds and API can improve an immediate view, and wherein the company sits in that hierarchy can also give further color to its standalone credit profile. And finally, any of this data enrichment that you're hearing of will need to be mapped to whichever data provider you engage with. So cross-referencing databases and a tool that can help with the automation of this mapping, ideally utilizing technologies such as machine learning, speeding up the mapping process and suggesting the best matches are quite wanted here. These are some of the solutions that we provide to our clients as well. Now moving on to the next slide on the detailed credit analysis. We know from customer interactions that during this process, there can be lots of back and forth from customers or counterparties on the financial receipts and getting them into the correct format. This can require a lot of effort and become an obstacle for customers that can cause them to stick with their existing business relationship, which again ties into the first response on polls that we conducted with our clients. The more comprehensive the credit risk analysis, the more challenging it is to automate as you start to layer in additional factors that can affect credit risk. Looking at risk through the cycle or at specific points in time, including factors from new and evolving areas such as ESG, which will no doubt add to that complexity and lead to more manual approaches, may be expected. Payment trend data trends tend to have a stronger coverage in certain geographies, but can also provide useful liquidity insights. The maximum credit limit can be a simple enough calculation which can lend itself to automation here. But in addition to financial inputs, you ideally want to incorporate your own risk appetite, credit scores, liquidity risk, and other useful factors. Ultimately, you want your pricing or credit terms to properly reflect the risk about providing that credit. And analysts with an abundance of qualitative adjustments can also be a barrier to that automation. Creating the credit memo presentation in and in itself could also be manual, but this should not be super complicated. But in many organizations, there still exists many processes of copying and pasting information from disparate systems and not having a standardized credit memo or a presentation format. So here, the first recommendation is to use financial spreading tools via softwares. Ideally, these products should first automatically extract financials from the customer's document, then allow for more involved spreading of financials. With the ProSpread tool, that's what we've aimed for to resolve. I also recommend here prioritizing credit factors that can be received in an automated fashion, minimizing manual adjustments. So for example, if you can make adjustments based on some business factors like size of the business, employees of the business, or other automated efforts, which can also factor in those priorities. Also think about if additional financial and non-financial items really add value in credit scoring compared to the time taken to source them, the right way to source them, spreading them, and computing them. Highly correlated items don't add additional insight and could actually distort results, right? So in a nutshell, sometimes less is more when it comes to the inputs and the factors that you use in your credit assessment. In terms of company financials access, your organization should literally have millions of companies at your fingertips that you can use in your calculations or as an additional check against data provided by the customer. All financial and non-financial factors used should automatically feed into your ERP and credit scoring engine. All financials should be centralized as well. So centralizing your data storage in a way that can be accessed across internal departments and systems would be ideal. A lot of time can be wasted re-entering the same information into different systems, as you can imagine. So finally, for your credit memo and presentation, you can use off-the-shelf solution if all of this is centralized, as well as reporting and BI tools to create those reports. Now on the next slide, we move on to the credit decision and approval stage. While you're waiting for approvals or silos, you have to keep your customers or counterparties updated in a quick time frame, especially in an environment where your competitors are becoming more and more technologically advanced, being quicker to deliver central decisions to their clients. It's really important to be first, to be right with the response to your customers or to your counterparties that you're considering doing business with. There are some points in the workflow where manual intervention is likely needed. So automation might not be possible, and you might need to find the right balance. Two of the most common points are when a customer or counterparty requests exceeding credit limits, or if data points are missing, which requires the manual intervention from the credit analyst to calculate the credit limit. So the balance between manual intervention and automation needs to be carefully looked at. Keeping stakeholders updated, i.e. those responsible for approvals or those that just need to be in the loop, updated at optimal frequencies, can also be difficult to manage here. And the operational aspects involving contacting lots of different departments to give access to a customer can also be quite time consuming and difficult to automate due to the multiple handshake for the systems that may need to be involved. The first recommendation here is to have rules, a rules-based approach workflow, and a criteria with exceptions where needed, which would then allow you to automate many aspects of the approval process. Starting with some simple rules around approvals, which could, for example, be based on a specific credit amount, let's say under X dollars. It can go through auto approvals depending on the stage in the approval. The internal approval request should also be enriched with whatever standardized data items or reports that can support that approval process. This can then give all involved sufficient information to make a decision. Triggers in your internal credit resistance should contain the relevant groups and people that are automatically contacted at certain stages. This should then be reviewed and called on a frequent basis. So moving on to the credit monitoring and surveillance piece. For the portfolio management side, where the customer is now on board and you need to monitor for risks and early warning signals of credit deterioration, receiving, processing information on updated customers, be it thermographic, insurance detail, credit reports, etc., in a timely manner can be difficult. And in the period it takes to collect that information, to process and validate the information you could already be taking on board is not factored into the changes that need to be made quickly enough. Onboarding new financials and other credit data presents a similar problem. The data will need to go through standardization checks and several validations. Payment trend data could also be another important piece of the credit puzzle and portfolio management. Coverage and access to this data can present a kind of hurdle to automation. Linked to the above, having a quick and automated assessment of portfolio deterioration can be impacted by the timelines of data inputs into your credit risk assessment engine. The first recommendation is to have frequent reviews on the health of that company. The more frequently you can do this, the better for the condition of that account. The more automated the process, the less time spent overall. Related to that previous point, having an auto-generated trigger or alert on the portfolio deterioration on the basis of updated information impacting credit quality and management of these accounts would be ideal. Back to a market sentiment in particular, in the gaps between updated financials, it is also important to pick up these early warning signals of credit deterioration. An extremely important part of credit limit assessment is the payment trend, and that the expected delays in payment delays in average days of payment, and that beyond the past due date, the payment terms, and so on. The updated information should be automatically ingested as soon as there is a change in the credit score. Then, of course, credit scores and credit limits should be immediately recalculated and updated on the basis of the new information. Now, coming to the last slide of this section, I will touch upon credit governance and external support. Of course, this is not relevant to all types of lending and credit arrangements, especially depending on your type of business. But I separate out this step, as any changes in these guarantees or of collateral or support arrangements agreed to by your customers can impact the level of risk you assign to that company. The real challenge for automation here is around checking for collateral expiry and requesting updated collateral. Also, verifying if there are changes in parental and government support dependent on the company's relationship with its parent. There could also be an enhancement of their credit profile, or it could have a neutral or negative effect. So the exact way that this updated information should impact the credit score is critical and can require some human interpretation, which affects the ability to automate, recalculate these credit scores. The recommendation here is fairly straightforward. We'll start with having a centralized database, customer collateral details with alerts on expiry dates. Upon expiry, there should also be an auto-initiated request to customers for updated collateral details or guarantees or any other information which is relevant within the whole credit covenant process and is still a support. The credit scoring framework that you use should automatically factor in parental and government support. This is something that we do at S&P Global Market Intelligence with our credit analytics product. Customer ownership and hierarchy details basically continue to be important here as an indication of changes in the company hierarchy. And as previously mentioned, this content can be accessed across numerous delivery channels. Finally, as much as possible, you should be interpreting signals in the data which can be fed into the models as inputs, reducing manual intervention, and should then be a trigger and as an updated and auto-generated credit score and limits. In the next section, we will now go through some of the solutions that we can provide to automate the workflow. The next slide provides you with an overview of our various solutions across the credit spectrum. Of these, I will be zooming into and solely focusing on the highlighted models that is available via the Credit Analytics Suite. This suite of statistically trained models help you to reliably score as well as efficiently monitor the risk of your customers or counterparties. Additionally, it has been built out with sophisticated workflow tools that will help you quickly and easily measure the credit risk of rated, unrated, public, and private companies across the loan book. We have different models, so we're going to go into each of these models briefly before I go into the solutions themselves. The first of these is the credit model. This is based on fundamental data, but it is aligned more closely with S&P Global's ratings, issuer ratings, as it is trained on the ratings output. The output of this model is a lowercase letter grade. It covers both public and private companies, but we recommend that this model be used for corporates where revenues is more than at least USD 25 million, or for FIs where assets are more than USD 100 million. This output is a medium to long-term view of the credit assessment of the company. You then see the PD fundamental model, which is then used to shed light on the likelihood the company will default in the next 12 months. This is trained on our default flags and it covers both private and public companies. It is globally applicable and has no size restrictions, unlike our credit model, and is again a medium-term view of credit assessment of the counterparty or the company. And then last but not the least is the market signal ability of the model and provision of default probabilities. This provides you with market embedded risk of the company and serves a point-in-time view because it uses equity information using a Merton model-like approach. And typically, this is used as an early warning indicator. Below all of these, you see the risk gauge score. Herein, we are combining the market-based implied risk and the fundamental risks to arrive at an overall risk assessment of the company. This is daily generated data and is helpful for monitoring purposes. Then you see the PaySense model on the side, wherein we utilize the B2B relations, trade, and utility payments to arrive at the predictive payment behavior of a company. And the resultant PaySense score can then help determine how best the company will pay its obligations. Last but not the least on this slide, you see what we have as the max limit framework. There we use the risk assessments to determine the maximum exposure that you can have in your book for a particular entity. We also have millions of companies with financials that correspondingly allow us to auto-generate the credit scores for these companies, or as I often say, pre-score using these models. Now on the next slide, you see that these scores can be made available via our different enterprise analytical channels. All the pre-scores in the financials are also available via Snowflake and ExpressFeed, as well as the API. Snowflake and ExpressFeed is a field view of the data points, which is an FTP approach. And this is mainly suited when you have what you need to add the data yourself in-house. Of this, Snowflake is where you want to have no maintenance, and it's more of a cloud integration. Other than that, the API approach is where you want to have only online access to the data, which you want to integrate into your own risk management workflow directly. In addition to these pre-scores, the financials, we also have credit analytics web services approach, wherein you want to generate an on-demand credit assessment of the company using our credit models, but you can also effectively integrate that directly into your risk management workflow. Now, moving on to the last slide of this presentation, you will note that we also offer financial spreading through ProSpread, which is also available as a service. What this does is to allow you to extract financials and map them automatically to line items and income statement, balance sheet, cash flow statements for the financial statements. It can also calculate ratios, which can be further user defined if need be. You can process documents in various formats, such as PDF or a JPEG or any other image format as well. We support multiple languages for ProSpread, I think over 10. And if multiple files are there, and fragmented financials, all of this can also be uploaded together. In fact, both Credit Analytics and ProSpread are solutions that we're looking to offer as containerized offerings in a client-tested environment, and this will be available in the future as well. So in summary, the first step as a part of integration would be typing the entity into our database of existing demographic information and financials, which will then be used to generate pre-scores from Credit Analytics. This will then help with credit decisioning and arriving at the maximum exposure. On the other hand, if there are no pre-scores due to lack of data, but you have the financials available at your end, then you can use either our ProSpread service to extract automatically and then generate credit assessment out of the extracted financials, and then further use it for your automated credit decisioning. With that, I'd like to conclude my presentation. Thank you for your time and have a good day.
So we're just about on time, and I see a bunch of questions which we will unfortunately have to answer off the webinar. What I'm going to do is perhaps just pick one. What I see here is your solutions look great. They're very comprehensive, but do you also work with third-party integration providers? So yeah, I guess the short answer is yes. We're always open to working with integration providers. We have already done several integration projects with fintech firms globally and software service providers. One such partner is HighRadius. But if there are other specific partners that you work with, we can certainly facilitate the upload process for our content into their framework and provision that through to your systems as well. Apologies, we're now out of time. And what I really have left to say is thank you for attending this session and your time today. And we look forward to you joining us again soon in the future. Thanks.